Great day, ladies and gentlemen, and welcome to the SOFTRAX Executive Webcast Conference Call. My name is Katina, and I will be your coordinator for today. At this time, all participants are in a listen-only mode. If at any time during this call you require assistance, please key star followed by 0, and the coordinator will be happy to assist you. As a reminder, this conference is being recorded for replay purposes. I would now like to turn the presentation over to our host for today's call, Mr. Bob O'Connor, President and CEO of SOFTRAX. Please proceed.
Thank you very much, and welcome everyone to today's webcast. As I'm sure many of you know, SOFTRAX is the leading provider of revenue management solutions to hundreds of companies, most of whom operate on a global basis, and many of whom join us on today's call. We have over 1,000 registrants for today's webcast, which indicates how much executives want to hear about today's topic from our distinguished speaker, Dr. Tony Sondhi, who's backed by popular demand to make his presentation entitled International Financial Reporting Standards and Revenue Recognition. Tony started this series in February, and he continues it today based on everyone's feedback from the previous session. Let me just take you through our agenda for today and a few housekeeping issues. I'll spend a few minutes on SOFTRAX and revenue recognition and for global companies, and I will then turn the proceedings over to Tony, who will make his presentation as appears before you. And after that, for those of you who are unfamiliar with our webcast format, we do leave some time before the top of the hour for you to ask questions at the conclusion of Tony's prepared remarks. And all of this will be done by the top of the hour. To ask questions, what you need to do is at any time during the webcast, you can click on the Ask a Question feature on your console and type in a question. I'll be reading the questions during Tony's presentation, and I'll ask him, as I said, towards the top of the hour. Now, the most commonly asked question, and we've already received it, is can I get a copy of the slides? And for those of you familiar with Tony, there's a lot on each slide, and you're going to want copies of the slides. So the answer is yes, but we do make you do some work. We ask for about a minute of your time. So upon the conclusion of your webcast, your browser will be automatically directed to a short online survey page. We listen to these. This particular webcast is a result of feedback from previous webcasts, so we very much want you to spend about a minute filling that out. That will allow you to get the copies of the presentation slides and an email for a link for a recording if you want to listen again or share it with a colleague. And if that weren't enough, everyone who fills in the questionnaire and also checks the CPE credit box will get 1 CPE credit, and 10 lucky attendees will get a copy of the 2008 Revenue Recognition Guide, which Tony is a co-author of. A very significant book that will ship to 10 lucky people who will draw out of a hat. So that concludes some of the housekeeping issues. As I said, let me just spend a few minutes on SOFTRAX and how we fit into today's topic. We do develop enterprise software that manages all aspects of a company's revenue cycle throughout the U.S. and throughout the world. Several hundred customers from many different industries use our software to manage their complex billing, revenue recognition, revenue reporting, and forecasting. And as you may know, SOFTRAX started by serving the complex needs of the software industry, and we're the clear leader in that market. And as you can see, we have grown to address the complex revenue needs of several different industries. Let's take a few minutes to just take a look at some studies in terms of the implications of revenue on operations as well as strategic issues. Studies by RevenueRecognition.com and IDC provide some interesting data. The first here talks about internal controls and the most difficult areas to establish effective internal controls, and not surprisingly, the top 3 relate to revenue recognition, contract management, and spreadsheet reporting areas that we focus on relieving our customers of that pain. And in another study, it was found that 92% of public companies use spreadsheets for critical revenue recognition issues, which is causing material weaknesses and other issues that people need to resolve. And this finding also relates to the last study with respect to spreadsheet use, as 57% of public companies cannot finalize their revenue numbers within their monthly close process. And this delay of up to 3 weeks is usually driven by the complexity of the transactions and the fact that the required information is not available within the timeline needed to close. All of these studies in great detail can be found on RevenueRecognition.com, which I urge you to visit. And thank you for your participation if you happen to do so. One of the latest reports that you'll find there, which is not on these screens, shows that in the time of revenue restatement, if companies are subject to revenue restatements, and it looked at almost 700 revenue restatements recently, in a time when the stock market was going up during that period, about 10%, the average of 10% of a company's value was eliminated as a result of these revenue restatements. So it's clear that revenue issues continue to plague public companies, and the effect on shareholders is very significant, and you can see that study very shortly on revenuerecognition.com. Let me just spend a few minutes on operational challenges that CFOs, controllers, and other financial professionals have. They are juggling their business models. On the left-hand side, has been a proliferation of business models, whether there's on-demand businesses, SaaS businesses, subscription-based or transaction-based businesses, or maintenance or renewal-based businesses. We see many people with hybrid models and introducing more models, which create operational complexities, as I mentioned. In addition to that, and at the same time, companies have to deal with revenue recognition guidelines that we all are very familiar with, and also they're under great pressure to improve their financial and reporting visibility. However, we do see companies who are trying to address these challenges with a host of disconnected and manual systems that create very significant problems when one is trying to scale a company, especially a global company, especially those that are doing many of this work manually and consolidating things across the globe. And in addition to the strategic issues, this disconnected and manual approach dramatically affects company performance, including profitability, cash, and other operating efficiency issues. And our applications are closely aligned with the previously mentioned challenges that companies are facing. We have billing and operations applications that help in terms of contract management and billing, unparalleled depth in terms of revenue recognition functionality, and analytical applications that are needed to improve visibility and help make strategic decisions. And all of these unique functionality can be licensed individually or together and really packaged in terms of two offerings. The first is a complete billing and revenue management application, depending upon the industries, whether it's software, SaaS, and others that you see on your screen. And the second offering that we have is for those companies who've previously invested in an ERP application. So as you see, Oracle, SAP, and Microsoft for starters. And our Revenue Manager product is really the most robust application on the market that provides revenue recognition, allocation, scheduling, forecasting, and other capabilities that can operate and interoperate in this ERP environment. So our mission is to help our customers increase their revenue, reduce their cost, and comply with the regulations that we all have to deal with in today's environment. So let me introduce Tony Sondhi, and Tony, if you can fire up your slides, and you can get ready to take over the proceedings at this time. Tony Sondhi is currently a member of the Emerging Issues Task Force, EITF, of the Financial Accounting Standards Boards, FASB. His resume is quite long, so I'll abbreviate it with your permission, sir. He is relevant today. Tony was also an advisor to FASB on its project comparing U.S. and international financial reporting standards. He's a co-author of the 2006-2008 Revenue Recognition Guides and the Analysis and Use of Financial Statements. Tony's consulting activities include revenue recognition practices in the software industry, revenue arrangements with multiple deliverables, financial reporting requirements, and the list goes on. So needless to say, he's eminently qualified to address the group today. Welcome back, Tony. Thank you very much for coming.
Thank you, Bob. I appreciate all the kind words. So let's get to work. As Bob has pointed out, we're going to talk about international financial reporting standards with a specific, of course, emphasis here on revenue recognition. And obviously we're trying to understand what we today, those of us who are applying U.S. accounting standards, what is it that we need to watch out for? And also, as Bob pointed out, I began this series, in a sense, with the first webcast in February. And I think February was probably considered, or at least most people felt that it was fairly general. I've decided today to take a somewhat more specific look at two aspects, and we'll see how much time we actually end up with and what we can do with respect to that. Of course, what's going to happen here is that I'm going to point out some issues, and you're probably going to feel that I've asked more questions, or maybe just simply added to the questions that you already had, but hopefully they'll point you in the right direction. I'll give you a sense of where to look for some of the potential, some likely answers as well. So, as I said, let's get to work with this. And what I wanted to talk about, and this is first 2 or 3 slides just go back to what I had last time for you. And I do want to remind you, and for those who are attending for the first time, I just want to mention that when you look at the fundamental principles of revenue recognition, there's no question that both U.S. GAAP and International Accounting Standards, what we're basically going to call IFRS from now on, those are actually quite similar because they're both derived from the concept of the completion of the earnings process and the ability to obtain assets and to realize the assets that are a result of this earnings process. Of course, the other point that I'm sure everybody who's interested in these issues is aware of is this widely held belief that just like every other aspect of International Accounting Standards, revenue recognition guidance and the IFRS is also basically principles-based, essentially principles-based, I should say. It relies on broad guidelines, and there's little, if any, implementation guidance. And clearly, in the U.S., as everybody's aware, we do have a fair amount of implementation guidance, or maybe some people would characterize that as excessive implementation guidance and maybe an emphasis on rules rather than on the principles of revenue recognition. But please keep in mind that all of this is very critical, and among the many reasons that Bob gave you earlier for thinking about this, I'd like you to keep in mind that revenue recognition, revenue restatements continue to be a majority of the restatements that we see out there in the marketplace in the U.S., and more importantly, as he pointed out at the start of this session, there's a rather significant drop in your stock price at the time that a company has a restatement. So from that perspective, it's important to understand how to apply it correctly, and clearly it's a matter of great importance to try to understand what's going to happen with respect to revenue recognition guidance when the International Accounting Standards are used all over the world, which certainly seems likely at this point. So from that perspective, I think it's very important that the standard setters develop a comprehensive plan with respect to implementation guidance, but we can help ourselves by thinking about it in advance, and that's what I'd like to provide some help with respect to. So now, as I said, we've got significant amount of implementation guidance. It comes from many different places. The SEC provides a rather significant amount of guidance as well, and obviously since the SEC monitors the way people apply accounting standards and the kinds of information they provide to investors, we certainly get a fair amount of information there as well. But keep in mind, as I pointed out the last time, one of the fundamental distinctions between what's happening in this country and is happening elsewhere is that we have an SEC. It's an enforcement mechanism that, at least I believe, it works rather well. On the other hand, there aren't too many countries that have good, efficient enforcement mechanisms. Now, I know that in the past we've all felt that the UK monitoring system is very good, but as you can see, the UK has not been immune with respect to the current credit crisis, Northern Rock being one example. So even though the UK has a very good monitoring and enforcement mechanism, And it's also there again, I think it's worth pointing out, that the UK system is widely regarded as a principles-based enforcement system, whereas certainly the SEC isn't, and yet they're both today suffering, in a sense, from the effects of the credit crisis. So it makes it very important for us to keep in mind that as the accounting standards change and as more and more countries in the world begin to use international financial reporting standards, this issue of enforcement is going to be critical. Now, again, as I said, if you want more evidence about the fact that the world believes that the IFRS are principles-based and US GAAP isn't because it's more rules-based, just take a look at the discussion between in Canada today about moving more rapidly towards the IFRS, adopting those, and you'll see that the head of the accounting standards group there was recently quoted as saying that the Canadians have always been more principles-oriented than the U.S., and so it's time that they actually decided to move much more clearly into the international reporting standards. And again, the issue is, does the principles-based system serve the interests of investors? And you know that I would say that because I am, at heart, an analyst, and I think about financial reporting from the perspective of the use of financial information. Now, I do want to show you that, want to remind you that when the FASB undertook the comparison project, they actually left out an analysis or an evaluation of revenue recognition standards. And the portion of the FASB report that was devoted to revenue recognition was actually not subjected to external review, but it's still worth taking a look at, just as there are other documents that compare, and other publications, I should say, that compare U.S. and international financial reporting standards. Okay? Now, let me begin by talking just briefly about the current revenue recognition project. It's been underway for a fairly long period of time. I understand that they've been working pretty hard at it. Both boards are involved in it. The objective, as it says here, the principal objective, is to develop a single comprehensive statement on revenue recognition with the idea of developing conceptual guidance that would be applicable to all business entities. Now, you'll see, however, that even though that's the objective, the boards have left themselves the possibility that they may decide ultimately that they cannot do this with respect to, at least not in the initial stages, with respect to every business entity, and therefore they may exclude certain transactions and industries and then address those later on. Now, at this point in time, it's hard to tell which transactions and industries will be excluded. It's really unclear. I don't know whether software is going to be one of those, but we certainly today have a very specific and sort of distinct set of standards that apply to software. And it's in principle, those depart to some extent from what we see for other accounting standards. So we'll see whether software is included in the general set of standards that are issued first. In addition to that, of course, the project is intended to achieve as much convergence between U.S. and IFRS as is possible. The boards are interested in eliminating inconsistencies in the accepted conceptual guidance that we have today. And of course, they're also interested in filling those voids that currently exist in revenue recognition. Now, if you look at all the guidance that we have, you'll see that in spite of having that much accounting literature devoted to revenue recognition, you'll find that the problems persist. There are differences. They crop up periodically. The way I see them is when revenue recognition problems are sent to the EITF Agenda Committee, and all of us members of the EITF then get a chance to review those. And as of the last meeting, we've actually also been able to comment and provide our comments with respect to which projects ought to be undertaken and reviewed by the EITF itself. For example, at the March meeting, we looked at two very critical issues with respect to revenue recognition. One of them had to do very fundamentally with the idea that what is the appropriate revenue recognition when you have a single unit of accounting but multiple payment streams. Because you see, our basic principles say that payment streams should not drive revenue recognition. So EITF 0801 is a very important accounting standard, and I urge you to follow what the EITF does with respect to that. I hope that we'll reach a consensus. We're scheduled to discuss it again at our June meeting, and I would urge you to attend. And if you can't attend that, then please make sure that you review the minutes of the meeting when they're made available to the public. Now, as I said earlier, software revenue recognition remains the most difficult and contentious area. Bob has told you some of that. I mentioned a few things. Here I bring up again the recent academic research that shows significant declines. And in fact, another indicator of how important revenue recognition is, I'm starting to see doctoral dissertations being done on SOP 97-2, and people are starting to ask what impact the specific revenue recognition standards for software have on the marketplace. Now, at the moment, the international accounting standards don't tell us much about, if anything, about software revenue recognition. The majority of foreign companies, as I pointed out the last time, do use the U.S. accounting standards. But I must say that the disclosures with respect to software revenue recognition are extremely poor. In part, that may simply be due to the fact that 97-2 and 98-9 don't actually ask for much disclosure. In fact, I believe that those two standards and the earlier EITFs almost had basically very little disclosure in terms of disclosure requirements, and so companies don't necessarily provide us with much. Another example is EITF 0021. The disclosure requirements that are stated in 0021 are actually, I'll say it very honestly, I believe they're completely uninformative. And the SEC has, over the last 3 or 4 years, actually done a very good job of delineating the types of disclosures that they would like. They want companies that are affected by multiple element arrangements to provide. So when you think about that, given that the international standards don't say very much about software revenue recognition, they don't say very much about multiple element arrangements, obviously those disclosures are not going to say anything much about it either. So in that sense, there's a lot of work to be done over here with respect to the differences. And clearly, from the perspective of a U.S. company, something that a U.S. company would be very seriously concerned about then would be the fact that are they at a disadvantage as a result of this? Because they're required to provide certain kinds of information. They're required to follow certain standards, but those standards don't exist at the international level. There's enforcement in the U.S., and it's not clear that there's enforcement of the same level elsewhere.
Just one question, Tony, here. Regarding EITF 0801, as you mentioned, do you differentiate between the payment streams from deliverables as they relate to EITF 0801?
Yeah, what's interesting is that very often what you have is payment streams are related to deliverables in the contract, but the evaluation or analysis of deliverables once you start applying 0021 may actually, or any other higher level standard, may actually tell you that there are completely different sets of deliverables, or maybe the stated deliverables have to be combined once you applied EITF 0021. And as a result, the payment streams, as provided for in the contract, no longer relate to the deliverables that you've then come up with after applying the accounting standards. So there's that disconnect that occurs. And that actually is at the heart of EITF 0801.
Okay.
How do you then relate the deliverables to the payment streams? And to what extent should the payment streams drive revenue recognition? And,
okay.
Yeah.
Thank you. Keep the questions coming, folks.
Okay. So specifically what I want to discuss today, I want to focus on the fact that in the U.S., one of the most fundamental components of revenue recognition with respect to software is the need and the use of VSA of Fair Value. In other words, the vendor-specific objective evidence of the fair value of the deliverables that have been identified in the contract. Now, that's one aspect. The other aspect is that I want to spend some time on has to do with the application of EITF 0021, specifically, though, the issue of contingent revenue and cost deferral in 0021, and the fact that there is very little, if any, guidance in the international standards on how to deal with both of those issues. So let's begin with a discussion of the VSA of Fair Value. And I'll start, of course, by just simply talking about how we use fair value. Everyone on this call, I'm sure, is aware that the use of fair value has become more pervasive today than it was even last year, for example. So in financial reporting, fair value is very important. If you've been reading the newspapers, at least the business section of the newspapers, it's very difficult to have missed how critical pricing is, how critical fair value has been to what's going on and what the crisis that's unfolding in front of us with respect to mortgages, subprime mortgages, some of the problems with the ratings that the rating agencies certainly seem to be having in spades, I would say. When you look at all of that, you see how critical and how central the concept of fair value is with respect to this. Now, keep in mind that, and you know this because if you've been working on software revenue recognition, you're quite aware, I don't need to remind you, that fair value is absolutely critical to revenue recognition in software as well. Not to, given the fact that we begin with VSA of Fair Value. But another aspect that I'll remind you about is that in financial reporting, when you're talking about revenue recognition, when you're thinking about revenue recognition, the analysis of performance obligations is absolutely fundamental as well. So when you think about the performance obligations, the customer's refund rights, for example, customer acceptance provisions, the customers or the issue of concessions, these are all components of revenue recognition that call for a very, very good understanding of the concept of fair value, the concepts of pricing. Now what happens, though, what's interesting is that US GAAP and the IFRS, the IASB's standards, have actually some fairly obvious and some subtle differences in fair value. And there are a few places in the world economy today where there's more of a fundamental disagreement with respect to fair issues. Fair value is one of the places. I think there are cultural distinctions between the way we think about fair value. The French, the Europeans, they look at these issues differently than we do. And there's no question that there's a wide gap between the way we look at fair values, even from the perspective of preparers versus that of analysts in the U.S. But when you add to that the effect of the difference between the opinion in the UK and Europe relative to the U.S., you see how big the gap can be then. Now, given that that is the case, particularly with respect to software, we have to be very careful, because the question is, how do these differences in the definitions, in the concepts of fair value, in the measurement of fair value, in the disclosure of fair value information, how do these differences, how are they going to affect us if we have to adopt the IFRS, given that the IFRS, I take that back. When is what I should say, not if. So the question is, when we have to adopt the IFRS, how is that going to affect documentation? How is that going to affect verification? The kinds of information that we need in order to have appropriate internal controls. What are auditors going to do with respect to the distinctions? The auditors are only now, I think, been getting more and more familiar, they're getting more comfortable these days with auditing fair values, with auditing VSOE of fair value for software companies. What's going to happen once we all start using IFRS? Of course, the best, in one sense, although I had to stop there because I thought maybe I'd hear disagreements. Actually, I can't hear disagreements, even though I know everybody listening is on mute. Because I was just about to say that one good thing would be that we'd have to use software revenue recognition standards that exist in the U.S. But then I remembered that there are quite a few people who don't like them that much. But as I said, in the IFRS, we don't have one today. We don't have a software revenue recognition standard. Now, having said that, we pointed out the primary issue. Which measure of fair value will prevail? Fair value measurements that we have in other accounting standards, and I'm going to give you a quick look at those, or are we going to use VSOE of fair value? Now, you're all, of course, also aware that we do have a fundamental issue in the U.S. 97-2 and 98-9 call for the VSOE of fair value. EITF 0021 says objective and reliable evidence of fair value. There are separation guidelines in SOP 81-1, but I don't think there's much in there about fair value. So when you look at those differences in the U.S., you have to ask, what's going to happen when we start using IFRS? Another issue is you have to ask is about the reliability of the estimates and the evidence of fair value that's used in revenue recognition, either directly when we use VSOE of fair value, or in other cases when we're using it for the measurement of performance obligations, such as refunds, etc., for example. Now, what's our definition of fair value? Of course, everyone at this call, I'm sure, is quite comfortable with and aware. There I go again, I said comfortable. But you're at least aware of the basic definition that's used in 97-2. Because in paragraph 10, SOP 97-2 says that VSOE of fair value is the price that is charged when that deliverable or element is sold separately. Now, please notice the critical elements of this definition. First of all, we're talking about vendor-specific objective evidence of the fair value. So we're not looking at the marketplace. We are asking, what is the price at which you, the reporting entity, normally sells a particular item? Now, of course, I've also put in here what we do for fair value when an element is not yet being sold separately. But let's put that aside. Let's just focus on the fact that the basic definition provided in 97-2 says that it ought to be the price at which you normally sell an item. Now, what kind of evidence do we use? Many people use a bell curve analysis. And you know, we've talked about that in the past during my webcasts. So the bell curve analysis tries to provide the evidence, the documentation that's necessary to say that we can use this and therefore we can recognize revenue. Please keep in mind that fundamentally the documentation, the evidence that you collect for VSOE is also a big part of your internal controls. It's what the auditors are looking for, the information they're looking for when they want to amended, and I can say very honestly, in many places much disliked, IAS 39 says that the best evidence of fair value of a financial instrument is quoted prices in an active market. In other words, quoted prices that are regularly available from an exchange, a dealer, broker, industry group, a pricing service, or regulatory agencies. Now, when you look at that definition carefully, you'll see there's quite a difference between regularly quoted prices from an exchange compared to those from a pricing service. But the point is that we use those, and that's our definition of fair value. The objective is to use prices from actual and regularly occurring market transactions that take place on an arm's length basis. Now, IAS 39 very clearly says that when you don't have active prices or quoted prices from an active market, you can use valuation techniques. Now, where available, of course, you can also use the quoted price for a comparable product or service. But I remind you, I'm sure that you've been thinking, you must have thought about this at the same time, as I said that. In 97-2, one of the basic principles is that it's not really possible to find comparable software. So for so many of the requirements of 97-2 and 98-9 make that assumption. So, for example, third-party evidence is not acceptable as fair value evidence in 97-2. It is in 0021. But I must say that, as I've said so many times in my seminars, I say that in my book, that I just don't know how you can get anything other than list price evidence from a third party. So from that perspective, it's hard to find places where you can use that. Now, other acceptable valuation techniques include discounted cash flows, option pricing models. I must say that I've always wondered about that because I can tell you discounted cash flows and option pricing models, two people could easily differ about the assumptions that go into those. So there certainly can be significant differences. In fact, I believe very strongly that consistency is pretty difficult to achieve when using discounted cash flow models for the same company itself, because as management changes, it's likely you're going to get a different price. Now, given these definitions in IAS 39, let's take a brief look at what US GAAP says about this. In US GAAP, particularly FAS 157 on fair value measurements, fair value is defined as the price that one would receive when selling an asset, or the amount you'd have to pay to transfer a liability in an orderly transaction between market participants at the measurement date. Now, in some ways, this is not all that different, you would think, from VSOE of fair value, because clearly VSOE of fair value is the price at which you normally sell that product. In other words, the price that you would receive when you sell an asset. But notice over here, it says the measurement date. So fair value in 157 is defined as the price that you would get on the reporting date. That's a different concept from a VSOE of fair value, because that's the price at which you normally sell an item. So I hope you're starting to see the differences between these two concepts. Now, 157 tells us that fair value measurements are rather specific, that they apply to particular assets or liabilities. Well, that's not at odds with the VSOE concept. The standard gives us guidance for determining the appropriate unit of accounting for fair value measurements. But there again, the concepts that we have for developing or determining, establishing a proper unit of accounting in revenue recognition are not quite the same as the ones used in 157. Now, like IAS 39, 157 does allow you to use valuation techniques. 157 goes a little bit further. And I'll tell you, I think that we're going to talk in a moment, just briefly at least, about 3 levels of inputs in the fair value hierarchy, you'll find language that sounds similar in IAS 39, particularly if you read the sections, the appendices to IAS 39, starting, for example, at paragraph A69, you're going to find lots of similar discussion. So I'm not suggesting that these are all that different. Maybe it's formalized in 157 probably in a slightly better way, or at least a different way than the IFRS. Now let's look at some other aspects of 157. It does say that with respect to consistency, comparability, with a nod to those, they provide a fair value hierarchy. 3 levels. Level 1, which is the highest or the preferred level, those are quoted prices in active markets for identical assets. Once again, these are markets that the reporting entity can access, and here we have it again, at the measurement date. Now the question is, do you think that for revenue recognition we should limit ourselves to level 1 inputs for prices? But let's take a look before we answer that question. Let's look at the other 2 levels. Now, level 2 GAAP talks about, or level 2 inputs, talks about quoted prices for similar assets and liabilities. In other words, you don't have prices for the asset that you're selling or the performance obligations that you have, but you look for similar assets and liabilities. Now that, of course, is clearly something you could not do in 97-2. Level 2 inputs can also, by the way, be based on inputs other than quoted prices. You get them from the marketplace, but they don't have to be effectively from quoted prices. And then you come to level 3 inputs. These are actually unobservable inputs. I would argue that basically what you're talking about over here is the entity's own assumptions about pricing and risk. Now, once you start getting into that, you have to ask yourself, how far are you from cost plus some kind of a profit margin? But if that's the case, then they certainly would not be acceptable under 97-2, at least not as it's currently constituted, which means that given that level 3 is management's observations, their representation, and it's the lowest level of the hierarchy, your question is that something that would be applicable to software revenue recognition? Are the inputs, are the answers that we get, the fair values that we get, would they be reliable enough for revenue recognition? There are meetings at the FASB where they've debated this, and I believe that there are some board members who've said that that it ought to be level 1 inputs at best, and no less than that. So, of course, there are other board members who feel that level 3 would be acceptable as well. But you have to ask yourself, how does that compare to the evidence that we look for in VSOE? Okay? Now, please keep in mind that for many performance obligations, which is one of the ways in which the current revenue recognition project seems to be going in terms of revenue recognition, looking at performance obligations, there, I think in many cases, all you're going to be able to do is level 3 inputs, because it's unlikely that you can get comparable information from others. You see, we're not talking about just extended warranty contracts that are available from 2 or 3 different providers. We're talking about a company's own performance obligations. So it's unlikely that we can go anywhere else, which means disclosures become critical. And as you've said before, I certainly am a strong believer in the argument that disclosures at the international levels are quite poor. So from that perspective, I think the IFRS has a very long way to go. Now, the next thing I wanted to point out was, please keep in mind that the questions we're thinking about is which fair value measures and which input levels then would be the most reliable estimates. And what about the fact, that's what I've been trying to do over here today, is compare what 157 and IAS 39 say about fair value relative to what we have in 97-2. And finally, what are we going to do? How do we change our documentation, verification, for example? And what impact is this going to have on internal controls when we move to the IFRS? Now, just a brief word about EITF 0021. Remember that 0021 in paragraph 14 calls for contingent revenue, and that can affect the timing of revenue recognition. Now, whenever you're faced with contingent revenue and you have to delay some revenue recognition, very obvious question is, can you then defer some costs? Unfortunately, that's issue 4 in EITF 0021, and the EITF decided not to not to answer that question. They worked on it for a very long time, felt that they couldn't deal with it, and therefore they left it. Now, the point is that the only material that we have, or the only guidance we have, comes from a 2003 speech from an SEC staff member at the AICPA National Conference, which lays out the principles of cost deferral. What's the comparable accounting standard at the international level? What's going to happen with respect to EITF 0021 there? And particularly, as I said, with respect to contingent revenue. So those are some of the, I think, critical questions that we need to think about. Bob, that's what I had for today, and I've just put up the slides for my coming seminars. I hope that our audience will take a look at these. And I've received some questions about my fall sessions, and I've also provided some information about my fall sessions, but they're mostly in terms of dates are still to be determined, locations. You'll see this is really, really helpful guidance. It's principles-based. It's East and West Coast seminars. So it's all yours, Bob.
Well, not for long. I'll get it right back to you. Thank you very much, Tony, and thank you, everybody, for their questions. Keep them coming. We'll see what we can do in terms of getting as many as we can. Tony, we go back to what you said in the beginning about 0801. If you could just make clarification about its availability, when, where, how people get their hands on it, and even provide a simple example of it just for clarification's sake. We had a few logistics questions as well as understanding questions. Okay.
The logistics first. The most comprehensive discussion from the FASB staff and the EITF perspective is the discussion of EITF 0801 in the materials for the March meeting. Those you can get on FASB.org. After the March EITF meeting, the minutes of that meeting were also put on the FASB website, so you can obtain those. Go to FASB.org, click on the EITF, and you'll find, you look in the left-hand corner, there's a menu, and in that, or a list of topics, and it's EITF is mentioned in there. Now, pretty soon, I'm sure that the FASB staff will also provide some materials for the June meeting. In the meantime, one other thing. A working group has been established to discuss and to help the EITF with EITF 0801. Our first meeting of this working group, I'm a member of it, has been set, I believe, for the 6th of June, so just a few days before the June EITF meeting. So you'll see what we come up with at the working group in the materials that are then posted for the June meeting. And that's what I would do, is go to the FASB website. So now, the second part of your question was a simple example. One example that I've been working on is this. Let's say that you have, and I'm going to use both deliverables that, let's say, are software deliverables, but for various reasons, they're subscriptions. And therefore, you can think of, this is software as a service type of issue. But the example I want to use is where a vendor sells a 12-month subscription and a 36-month subscription in a bundled arrangement. Now, please keep in mind that it's a bundled arrangement, so the first thing you have to do is ask yourself whether you can separate those. Now, let's assume for whatever reason, and the reasons could be you don't have sufficient VSA of fair value, or because it's service, I should say, objective and reliable evidence of the fair value for at least one of the undelivered elements. And, it's the interesting question, of course, is at the inception of the contract, when you've got one 12-month and one 36-month subscription, how many undelivered elements do you have? Now, when you think about it that way, you realize the two payment streams are, of course, the one will be for the 12-month subscription, which you get paid over the next 12 months, let's say, and the 36-month subscription, you get paid over the 36-month period. So those are your two payment streams. Now, if you can't separate the two deliverables, the 12-month and 36-month, you end up with a single combined deliverable, which, when there's such disparate, different deliverables, I tend to call that combined deliverable with a highly scientific term, amorphous blob. So now you've got these two, and the question is, you got two payment streams, how do you recognize revenue? So that's the example.
All right, great. We shift to VSOE and fair value, no surprise. How does one establish VSOE for items not sold separately or sold by others?
Well, see, of course, the first, there's two questions. The first one is, what do you do with items not yet sold separately?
Right.
And that, the paragraph 10 allows you to use the concept of management having relevant authority, can set a price, but you have to do it within a short period of time before you start selling that item separately. Now, one other thing I would remind people is that once you do start selling that item separately, you do have to make sure that you do a bell curve analysis or some other way of ensuring that you're actually selling the price within a fairly narrow range. The items that are sold by others, that becomes very much a function of the type of arrangement you have and what you're doing with respect to that. Certainly items that are sold by others, you can get a fair value in the marketplace, for example. But again, as I said, that really depends on the terms and conditions of the arrangement.
Tony, why wouldn't the IFRS move away from the VSOE standard and move towards the IAS 39 or FAS 157 definition of fair value?
Oh, there's no question that they could do that. I sometimes, get a sense that this revenue recognition project, one of the most important questions they're going to deal with is whether we need to have such a different standard for software. And then the question is going to be, what are the characteristics of software transactions that would call for such a big difference between fair value measurements in software revenue recognition compared to fair value measurements elsewhere? Now, if they decide that there aren't sufficient differences in software from other transactions, then it's quite likely that they will try to unify the approach and come up with maybe something similar to IAS 39 or what we have in 57 with maybe a little 157 with some more emphasis on the different kinds of inputs. And then maybe they'll try to resolve that by asking for different kinds of disclosures. So it's quite likely that that's where we'll end up.
Okay. You did discuss a little bit how Europeans think of the fair value in different terms. We had a few questions to ask for you to kind of expound upon their viewpoint as you understand it.
I think one of the more interesting, important differences is that if you recall the slide, the IAS 39, if you go back and take a look at it, you'll see that they talk about quoted prices that are regularly available from an exchange, a pricing service, etc. And I pointed out that those are quite different. I mean, in an exchange, very often, or many exchanges, there's an anonymous transaction at an arm's length basis. In a principal-to-principal market, there's nothing anonymous about it at all. and there's no distinction there. And it's interesting, but there is a difference in the pricing that you get on from those two markets. In the U.S., there's a little, as I said, there's quite a bit more of an emphasis on prices from regularly quoted markets and so on. But as I said, the other issue I pointed out is that some of our most difficult problems come when prices of fair values are based on valuation techniques. And I think it's there that we have a very big difference. There's a higher acceptance of valuation techniques that use level 3 inputs in the European markets, in the European financial statements in a sense, and in their standard setters than there is in the U.S. Now, of course, we do have a number of different instruments, both assets and liabilities, which in the U.S. are priced using level 3 inputs as well. And if you want to get a good sense of those, just open up any investment bank or large bank's financial statements, Goldman Sachs, Citigroup, Merrill Lynch, and you'll see what they are measuring. Lehman Brothers, for example, those kinds of companies. You'll see what they measure at using level 3 inputs. And also you'll see how little information there is in many cases about that. So I think that's the spot where we're going to have an interesting problem, because there's a slightly higher reliance and acceptance about those kinds of prices outside the U.S. Of course, I should also point out that in the U.S. there's a lot of talk about that pricing as well.
A couple of resource questions.
Yes.
They can direct people in the right area in terms of where they can get things. Is there a comprehensive discussion of inconsequential deliverables by the EITF? Inconsequential deliverables.
I think the best source would be to get your hands on the minutes of the EITF 0021 meetings. And there you'll see the discussion that led to the decision by the EITF to say that they could not actually come up with a good operational definition of inconsequential and perfunctory, and therefore they rejected that notion as it is used in SAB 104. So the minutes of the EITF 0021 meetings are probably the best place to find that.
And a similar question about cost deferral, specifically referenced the 2003 staff member speech regarding cost deferral or any other resource that has to do with cost deferral.
Two things there. One, I recommend that you take a look at his speech, and you can get that on sec.gov. Go to 2003 speeches, and you can find that. Now, in that speech, he refers to a number of accounting standards that talk about cost deferral, and then he sort of fashions his argument based on the principles that he refers to in those standards. There's a comprehensive discussion of that speech in my revenue recognition guide as well, so you can find it in there. I haven't looked recently in any of the regular textbooks, so I'm afraid I can't say that. But those two, hopefully.
Oh, that's great. And lastly, I just want to make a comment. We did get several people expressing their concern that you're only working your seminars on the West and East Coast, that you're ignoring places like Chicago and Dallas, and Denver. So if people seem to have a problem with that, so you might you might think that to not just fly over these people and come down and spend some time with the people in the middle of the country. But I'll leave that just as feedback. Thank you very much, Tony, for lending your time and expertise and insight to our audience. I also appreciate the time of the audience for joining us today, and thank them for all of their questions. I'm sorry we couldn't get to all of them. There is an opportunity on RevenueRecognition.com. If you look at your screen now, the forum section on RevenueRecognition.com allows you to interact with your peers and ask questions and interact amongst each other, people who are living the same issues every day. So I encourage you to visit revenuerecognition.com/forum. I also want to remind you that your screen will soon be have a URL for a survey form. It has it now, I can see. And what you want to do is we really want your feedback on this. This will allow you to get copies of Tony's slides. It allows you to get a link to the recording, allows you to get the CPE credit, and 10 of you will get the 2008 Revenue Recognition Guide. So please do that, and I encourage you all to continue to visit revenuerecognition.com and SOFTRAX.com and check your emails for future webcasts. These are driven primarily by the needs of our audience, so thank you for your time to fill out the questionnaire, and thank you for coming back for these future events. And once again, Tony, thank you very much. Goodbye.
Thanks, Bob.